Stock market warning. While everyone celebrates recent gains, I've been more skeptical, cautious. I'm seeing 5 signals, very different from each other, from chart, stocks, macro data, AI, that are warning us to be careful, and almost no one is talking about it. So, before you make your next move, you need to hear this. I'm turning cautious and I would like to save your portfolio from unnecessary risks. Knowledge is key, then you decide. Full disclosure, forecasting the macro, it's almost impossible. No one, and I say no one, knows the future. I like to predict it, but I'm attracted to crisis. I have a bearish bias that already made me miss big opportunity in the past, so after you hear my 5 points, you tell me, I'm just paranoid or this is real danger? Without any specific order, here are 5 reasons I've been careful. Reason number 1, the rise of uncertainty. If we look at the VIX, the fear index, we can see that during the last year we have been into a very choppy uptrend. So my feeling is that the market reacts to bad news faster than ever. We get these crazy spikes like the yen carry trade panic last August or the tariff spike lately. We experience sudden panic that quickly vanish while the market makes V-shaped recovery. But the overall volatility, the long trend keep increasing, signaling the fear of not knowing is real. The current US government doesn't help. It seems almost to enjoy this kind of constant drama. It doesn't care if it damages the global economies with tariff, with wars, with these power games with uncertain outcome. How far will it go and how bad will it be for the USA? I'm just saying, I don't think this is the way to make America great. Just my opinion, but uncertainty rising, it's a fact. Reason number 2. Valuations are high. As a value investor, I'm always looking for bargains, but lately it's very, very hard to find reasonably priced companies. Not cheap, reasonably priced. We can just look at the historical Shiller PE ratio over the last 150 years, and it seems quite clear that the US market isn't cheap right now. Looking at this chart, we have to wonder how long valuations can stay so high. Probably this high valuation is connected to the wealth concentration gap. Check this out. Since the 70s, the top 1% of the super rich have been continuously increasing their income and their capital and their holdings, while the bottom 50% of the population combined now own far less than the top 1%. Now, this kind of chart is deeply concerning and frankly, I believe it's quite disturbing. Anyway, without getting too political and explaining why this is wrong, the important thing here is that the wealth gap might be the reason why valuations are so high. The rich and powerful make so much money, they already own so much, they don't know what to do with all that money. So they keep investing, buying more and more stocks and house and real estates, everything, no matter the price. But I believe valuation will come down sooner or later. The system is broke and this trend can't last forever. Reason number 3. The illusion that the stock market will go up forever. Let me know if it's the same for you, but personally I hear almost every day some huge YouTuber or expert claiming it's guaranteed 100% to make money if you invest in the stock market in the long run because the US market always goes up. Now, at first glance, this makes sense. If we check the chart, there is a clear uptrend. There are some dips here and there, but the market always recovered. The problem is, even if the stock market always went up in the past, it doesn't prove it will always go up in the future. Please consider also that the US is the best performing nation in the stock market history, so this belief is heavily influenced by survivorship bias. The US stock market has outperformed over the last 100 years, but we are excluding all the other markets. Wall Street will not go up forever. There are a lot of examples of other markets that didn't go up. Imagine you invested in Japan in 1990. 35 years later, and you are still in the red, and we are not even considering inflation. Italy, my country, very similar, was 5th by GPT during the 90s, now it's here, 10th. I've seen personally what that decline means for the people, for the nation, for the market. For example, my mother started rich when I was small, she was very rich and ended up very, very poor. It's not nice, it's terrible. Don't be the one believing the great Roman Empire will never fall, the great British Empire will never fall. They do fall, it's just a matter of time. Dominance can last for a while, can even last some centuries, but eventually it doesn't last forever. So just be aware, I think China is coming. Just realized I forgot lamp, but reason number 4, the unemployment rate. It's very important, it's one of the Fed's mandate, and this is why I'm watching very carefully and I'm waiting for May's data. During the last year we have been stable, max was 4.2%, but 4.2 it's also the forecast for May. If we get 4.3, I expected headlines to call it the highest unemployment since COVID, and sentiment could start deteriorating fast. But that's not even my real concern here. The real issue is artificial intelligence. I use it every day, and I feel like I actually know I can do the work of 5 people alone. So by now it's clear it will boost efficiency extremely in every sector, in every industry. What is not clear is what companies will do with this newfound efficiency. Will they just produce way more and maybe lower the prices a little bit, or will they cut half of the labor force to gain more? My guess, it's a mix of the two. And given the speed in which AI is currently evolving, I expect to see huge spikes in job cuts in the coming years, and maybe a complete paradigm shift once humanoids robots hit the market. Basically, I'm forecasting big changes that will influence and completely change labors in the coming years. And as normal people, if we want to be smart, I believe as normal people we should start demanding for a universal basic income to be paid from corporations. Reason number 5. The technical chart of the S&P 500. As you know, I'm a value investor. I'm not giving much attention anymore about chart and patterns, but if we give a look at the chart of the S&P 500, over the last century, it has always traded between these trend lines. We can see the dips after the Great Depression in 32, the war in 43, the oil shock in 74, and the only one I personally witnessed, the financial crisis in 2009. Similarly, we can connect the peaks of 29, of the dot-com bubble in 2000, and today we are here again in the very high part of this range. If I switch to a daily chart and I zoom in, we can see that we are very close to touching the upper trend line, and the time might be right for a big correction. Now, my portfolio has been doing very well since I started this YouTube channel, and it's not like I'm panic selling everything, screaming exit the market, everything will crash. I don't know. But I'm getting more and more liquid lately, and I'm being more careful. I'm looking every day for undervalued stocks to buy something, but it's very hard to find anything compelling. I believe I find something, but that's the topic for the next video. If it's already published, you can find it here. Otherwise, please like, subscribe. You will get notified when it comes out. Thank you. Thank you for watching At The Economics. See you next week. Peace out.